We have been very cautious on China over the last 2 years, following very strict policies targeted at the technology, property, as well as the education sector. Coupled with the zero COVID policy, sentiments towards China credits has been very bearish this year. However, with the recent spread widening, we started to see some value, especially in the tech sector, and hence the team has added exposure in Alibaba as well as Tencent. The Chinese government is well aware of the stress faced by the various property developers since the end of last year, and hence we have been seeing a series of policies easing, and we expect that trend to continue. In the second half of the year, should we get some clarity around Evergrande's debt restructuring plan, that could provide a boost to the market. More importantly, we do need to see a recovery in sales, which we hope to see should the COVID situation in China stabilize. We were negatively impacted by the downgrade of Shimao, even though at the current price, we do think that it is pricing more like a liquidation scenario rather than debt restructuring. Hence, we are prepared to hold on to this position till the debt restructuring happens. Country Garden could potentially be downgraded in the months ahead, but with the bond price trading at a yield of above 20%, it is more pricing in a distress scenario. We do think that ultimately Country Garden will be a survivor of this crisis, especially given its access to the onshore market. We are comfortable to hold on to this position at this moment, and should bond price weaken further, we are actually prepared to add on to this exposure. A lot has been priced in by the market. A few months ago, when the Fed fund rate was still at zero, market is now pricing in a terminal rate of 3.5%. As we move into the second half of the year, should inflation starts to taper off, coupled with slowing economic momentum in the US, market could start to price in a recession, and that means long-end interest rate could actually rally from here. In short, my outlook for interest rate is actually not that bearish at this juncture. We have recently gone neutral as we believe that, as I mentioned earlier, market has priced in a lot of rate hikes by the Fed in a very short time. We have also been raising cash, which will allow us to reinvest at higher interest rate at this moment. The portfolio benefited from our short US duration positioning. We were also bearish on Indonesia as well as Philippines spreads. Those country spreads have widened significantly in Q1, and thus it has benefited the portfolio. Asian IG is currently trading at a yield of about 4.5%, which is actually looking very attractive. The last time it hits that level was in 2018 during the last Fed hike cycle, and before that it was during the 2013 taper tantrum episode. If spreads stay stable in the second half of this year, total return could actually be positive for Asian IG as an asset class. Should the market start to price in a recession scenario, the long-dated bonds could actually rally in the US and hence further boosting total return for Asian IG.
FSM1 助你惠視全球，投資致富。